Hello and welcome to the Morningstar series, Ask the Expert. I'm Emma Wall and I'm joined today by Peter Brunt, Senior Analyst for Morningstar. Hi, Peter.
Hi.
So we have been running a retirement week this week, and we've come to today, which is post-retirement investing. And in post-retirement, you are invariably looking for an income because you no longer have one from your job. But income, of course, is not just unique to the requirements of someone post-retirement. It's something that everybody's after. And UK equity income is one of the most popular sectors for UK investors, better the devil you know, but it's a very diverse sector. And I've asked you today to pick out 3 funds to sort of illustrate how diverse they are and how different methodology can produce different but very exciting returns. So what's the first fund you would like to highlight?
Sure. Well, just a bit of background. You know, the sector requires the funds to have 110% of the yield of the FTSE All Share. And so the 3 funds I picked today, just showing the spread, you know, they're all meeting that requirement, but the spread amongst that. So the first fund is the BlackRock UK Equity Income Fund. And that's run by 3 managers. It's a fund that we've recently brought into our coverage. It's a bronze-rated fund. And the reason why we liked it is BlackRock have a very strong UK equities team. They've had a bit of turnover over the years, but they've had more stability brought in. They had a new CIO brought in, Nigel Bolton, a few years ago. He's brought the team into a lot more focus, a lot more communication among the analysts and the fund managers. It's still relatively early days, but we like the team, we like the house, we like the fact they have more focus, and hence.
And it's a nice yield as well, isn't it? 4.7.
Absolutely.
In these days of extremely low inflation, that's actually very attractive.
Yeah. So they construct their portfolio with focusing on some high-yielding cash compounder names. They complement that with some more growth-orientated names and some turnaround stocks, which all of them will tend to yield, but not all of them will have a yield above the market.
And what's the second fund you'd like to highlight today? So
the second fund is the Fidelity Money Builder Dividend. And this is run by Michael Clark, himself an experienced analyst and fund manager. He's been on the fund since 2008, since when he's got a good track record. This fund is a little bit more focused up the cap scale. It's looking at the more conservative, more defensive kind of steady Eddie names in the FTSE All Share.
Are these the ones that we've come to know as bond proxies, high yielding but not necessarily high growth? Absolutely,
yeah. So he's overweight pharma, utilities. He's got some insurance names in there, which probably aren't such bond proxies, but the more steady, high yielding names. It performs as you'd expect as a result in down markets. It's very good at protecting your capital. Doesn't really partake in the sort of lower quality rallies in 2009, for example. And
what's the third fund today?
So the third fund is Standard Life's UK Equity Income Unconstrained Fund. In contrast to the Fidelity Fund, is really not looking at these higher yielding, steady Eddie bond proxies. He's really differently positioned to actually not only Fidelity but most of the peers in the peer group. It only holds, I think, 4 or 5 of the top held names in the peer group.
And that's that unconstrained element, isn't it? It's absolutely, that all-cap unconstrained, which of course can make for a less regular return stream as well. Is this a more volatile fund?
It is slightly more volatile, but interestingly, what's happened over the life of the fund thus far, he's been running it since the beginning of 2009. And the first few years, yes, it was a lot more volatile than the benchmark and peers. But in 2011, the fund had a pretty bad year. It was very aggressively positioned, probably a little bit further down the cap scale. But I think Thomas Moore has learned his lesson. I think that's one of the biggest lessons he's learned managing money, and he's now changed his approach to managing portfolio risk. He's looking more in absolute volatility now rather than relative to the benchmark. And he's done a very good job of reducing that volatility. And for the past 3 years, he's actually got a lower volatility than the benchmark. It's it's one of the top performing funds in the sector, and still gives a pretty decent yield. It's just above 4% at the moment.
Pete, thank you very much.
My pleasure.
This is Emma Wall from Morningstar. Thank you for watching.